Let's talk about the housing market and the upcoming housing crash. Now, in order to really understand the housing market that we're currently in, we need to take a look back at previous housing bubbles, how they exploded, and what was the result, and what were the market conditions surrounding it. So not only are we going to look at the great financial crisis of 2008, I think we should look at the Great Depression, we should look at the 40s and the 70s as well, and we'll compare all that together with what we have now, and I think we'll get a better idea of exactly what to expect. I mean, it is reasonable to think that we are in the biggest housing bust of all times. Let's start back in October 28th and 29th of 1929, the Great Crash. See, those 2 days, the stock market crashed 25%. Then there's a businessman from New York. He grew very skeptical of the banks and their ability to stay afloat because word was out. The banks were businesses that might just fail like every other business. So sure enough, by the end of the day, there were tons of account holders at the doorstep of the bank demanding all of their money. You see, back in the 1929 to 1930, 40 era, we didn't have an FDIC. In fact, the FDIC wasn't founded until June 16th of 1933. When people went to the bank to get their money out, it was because if you were the last to the bank, you might have been the one who was on the hook. So exactly how did banks go out of business? Well, they ran out of money. And the monetary system back then was much different than the monetary system we have now. You see, banks used to actually take our deposits and then turn around and loan them out to other clients for a profit, otherwise called an interest rate. If everyone took out their cash and the banks had no money to operate, they would end up going bankrupt. And the account holders did just that. They withdrew all of their cash until the banks were forced to liquidate their assets. And their biggest asset was mortgages. So the banks were forced to call the notes due, which meant that they had to go to the mortgage holder and tell them that, hey, you got to pay off your loan in the next 30 days or you have to leave your house because we're going to foreclose and sell it to someone else. We need liquid. Now, most people couldn't pay it in full, so there was a wave of foreclosures. In fact, by 1932, there were already 273,000 foreclosures. And the next year, banks would begin foreclosing on 1,000 mortgages per day. By 1933, 40 to 50% of all mortgaged homes in the US were in default. The home finance system started to collapse. And this caused a banking crisis, which became a systemic issue. So President Hoover came out and he signed into law the Home Loan Bank Act of 1932. Now this would help calm the market and bring liquidity to the markets because so many jobs were related to the housing market. In fact, by 1932, the unemployment rate was nearly 25%. And of the 25% of the people who were unemployed, 35% of those people were working within the housing sector. So you can see how big of a deal it was for the president, for Congress, and everybody to figure something out to get everybody back to work to fix the economy. The housing market crashes and the entire economy goes down with it. Okay, I want you guys to keep that in mind. Now, back then, they weren't equipped to handle all of those foreclosures, just like we weren't equipped in 2008. And because of this, Hoover had passed the National Housing Act of 1934. Now, this helped build confidence in the markets and it brought liquidity to the markets that the markets lacked. And soon, the construction began and the Great Depression lasted until only 1939. So let's see, what did happen to home prices? Well, during the Great Depression, the home prices actually took a hit of 35%, which is huge, and it didn't recover for 10 years. Okay, so on to the next thing that we need to look at was, let's go right up to the 40s. What was so unique about the 40s and the market in the 40s? Well, this is when we had an inflationary bust. By 1942, the inflation rate went up to double digits all year, and they didn't get back to the Fed's goal of 2% till after 1949. So what happened back then that caused inflation to run so high? Well, the Fed printed a bunch of money to get us through the World War II. So that money quickly made its way through the system and prices started getting bid up due to the abundance of money in the system. By 1947, we saw the worst inflation skyrocketing to a high of 18.13 in 1946 and as high as 19.02 in 1947. Wow. So what happened to housing prices? Well, in 1940, the median home price was $30,600. But by 1950, that number was $44,600. Those numbers are adjusted for inflation. So houses went up almost 50% during an inflationary bust. Keep in mind, we also had a pretty bad economy. There were a lot more tough times. So let's also take a look at another inflationary period. All right, so now let's take a look at the 1970s, because we all know that inflation was really out of control in the 1970s. I mean, if you were born in the year I was born, you heard your parents talk about it all the time. So what happened in the 70s was a combination of the Cold War coupled with bad policy from the White House. We also had the oil embargo of 1973, which ceased the U.S. from importing oil from OPEC in the Middle East. Sound a little familiar? We were also taken off of the gold standard in 1971 when President Nixon announced that the U.S. would no longer convert dollars into gold. And the gold standard meant that we were printing only dollars that had gold in Fort Knox to back it up. So if we had $100 worth of gold, you could take that gold to the bank and they would give you a $100 bill. They would get that from the Federal Reserve. Okay, so the period in 1970s was known as the Great Inflation. And it was blamed on oil prices, currency speculators, greedy businessmen, union leaders. Now, it's clear that monetary policies that financed massive budget deficits and were supported by political leaders were definitely the cause. The inflationary period actually lasted from 1965 all the way till 1983 when Paul Volcker came in to President Reagan and told him we need to up the interest rates above the inflation rate. And President Reagan agreed. This would cause a massive recession, but it did kill the inflation. So let's look at what happened to home prices in the 70s. Well, in 1970, the median home price was $65,300. But by 1980, the price was $93,400, which is almost double. So what is happening today? Well, as you're all aware, in 2020, we saw a huge pandemic which caused the world to go into a lockdown. The unemployment rate shot through the roof. But within 4 days, the Fed had an emergency meeting and decided to turn on the money printer again. Because printing money, they couldn't have any negative effects, right? So they actually did the unexpected and they printed so much money that now we're seeing some of the worst inflation ever. Now, the numbers will tell you that we're around 8.5 to 8.2, 9.1. But if you were to do the exact same calculation that they did in the 40s and the 70s, you'd be upward of 16 to 21%. So it's really a mixture of the 40s and the 70s combined as far as economic conditions. Now, the Great Depression was a deflationary bust. The 1940s was an inflationary bust. The 1970s as a stagflation type of a bust. So when we're thinking about all of these time periods, which one are we most related to? Well, I think we need to compare them all because they all have some similarities and some differences, and we can learn from everything that happened in the past. See, both of them had very different outcomes, but by planning for the worst, then you're definitely going to get past this with a smile. Now consider this. A man buys a home for $65,300 in 1970. And his payment was based on dollars from that day, meaning his total payment came out to around $434 per month. Now, inflation runs hot for like 10 years, let's say, but at the end of 10 years, that same payment would have been $964 by 1980. How would you like to have an asset that not only went up in value, but it also produced passive income? If that's for you, real estate is definitely the way to go during the inflationary periods. So by time 2003 came around, there was already a 68% home ownership rate, but that wasn't good enough for Congress. So Congress and the White House pushed for home ownership rates to get as high as possible. So by 2005, the banking system kind of took advantage of this situation and they started offering loans that were like stated income or negative amortization or subprime loans. An ARM that adjusted with a prepayment penalty. Wow, just so many programs. And by the way, even with all of these programs, they were only able to get the home ownership rate up about 1%, which is still a big number, don't get me wrong. It's about an extra 2.9 million homeowners. Now, by 2008, we saw a big crash where home values declined the second most in history. and they fell by 33% nationwide. The US was about to see the biggest financial crisis of all times, all due to mortgages that they offered and sold on Wall Street. Builders thought the party would never end. When the market demanded only 1.7 million homes in 2005, they built 2.2 million units. This caused the housing crash to last much longer because there were so many vacant units in the United States. And because we overbuilt in 2005, builders spent the next few years underbuilding. So like in 2009, 8, they were to 500,000, 600,000 starts. So the demand's 101.7 million and we're only finishing 500 to 600,000. And that went on for a long period of time. So it left us behind on inventory. Going into the pandemic, we didn't have as much inventory as we would have if these events wouldn't have happened along the way. So coupled with the inventory shortage and the low interest rates sparked by the Fed, what do you end up with? Lowest mortgage rates ever, somewhere in like the 2s and the 3s, but it's even lower than inflation in the 40s. In fact, from the 40s until now, inflation has averaged 3.79%. So the banks are really the losers whenever you take out a mortgage or a loan with an interest rate less than inflation. So how much longer before we'll see the crash or the values decline? Well, really, that's anybody's guess. We're still waiting on to see how things develop in the world. We have a war going over in Ukraine. We have no idea what's happening in China and Taiwan. There's a lot of things still on the table. Keep in mind the 40s, the 70s, and the 2008 and 2029 crash. And I think we're definitely closer to the 40s and 70s because during an inflationary period, if inventory and demand are pretty spot on, then I think that what you'll end up seeing is houses starting to be bid up again as soon as the interest rates come down just a little bit. All right, folks. Well, hope that you guys enjoyed this content. If you did, consider liking, sharing, and subscribing. We'll see you in the next one.